Nilesh Shah of Envision. Nilesh, fantastic to have you back. Thank you for joining us. So what should we start with? Fed, Nifty or straight away stocks?
The difficult question. Will Nifty hit 7,000 or not?
I thought the three were correlated, right?
Okay, let's start with Fed. Many experts believe that Fed has changed their official guidance, which means interest rates will go up. If the guidance has been changed officially, then markets should be panicking. There should be blood on the street, but that's not the case.
Well, yes, I think the Fed has changed its guidance. And it's not very surprising that there's not a very super knee-jerk reaction on the downside. And that's because if you really look at the emerging markets, leave aside India, they were already on a correction path. India is probably the only significant emerging market which is trading at a historic high. But everything else is probably still 20-30% lower from their highs over the last 1 year or 3 years or 5 years. So to that extent, I think already the emerging markets have been on a correction mode, and therefore you're really not seeing any significant negative impact of the Fed's change in guidance.
Tapering is a valid fear. But if tapering is a valid fear, what explains the kind of flows we've got in the last 15 days? We've got $1 billion plus in the last 10-15 days, and that's a big flow, and that's a big number.
Well, I think that's because most emerging markets today are looking relatively weak. Russia is having its own geopolitical issues. China, there are serious issues of capacity build-up and credit issues. Brazil looks a bit directionless right now. So all major economies today are not looking as good as what they were looking a year back or 2 years back vis-a-vis India. I think in that backdrop, India today looks to be a place of stability and a place of hope. That post 16th May, India will have a decisive and a stable government. So I think it's a combination of both these factors which is basically driving flows to India. And keep in mind that the flows that we've got are not very, very significant. I think year to date we've probably got $1 billion or $2 billion, which is not very significant in the global context. So to that extent, I think it's a combination of hope of stability and a hope of decisiveness, which is basically driving flows to India.
And Nilesh, that's the big question, right? How to approach this magical date of May 16? Do you go in the money or do you go fully deployed in the market?
I think it makes sense to kind of go in the money. And there's clearly because it looks like that there is going to be a decisive kind of a government post 16 May. So if your bet is that yes, we will have a decisive government, then it obviously makes sense to kind of go into this market with in the money kind of a strategy. You probably may want to leave some ammunition dry for areas like technology, pharmaceuticals, the dollar sensitives, where a correction has set in and might even get weaker before the guidance season sets in or the earnings season sets in. But I think barring that, by and large, the rest of the pack looks reasonably stable.
Your core investment thesis is stick to quality, buy into mid-cap consumers and load mid-cap IT stocks. Has your core investment thesis, has your portfolio approach changed?
Not in any significant manner. I think the core characteristics that you were really looking for investing, I think they remain the same. That ideally avoid companies with huge debt, avoid companies which really depend on bank funding, avoid companies which are still significantly cyclical. And even if one wants to look at bets on the domestic economy, look out for companies which still don't have balance sheet related issues. And the probability of earnings growth coming back over the next 2 to 3 years is very high, irrespective of which government really comes in place. I think that strategy remains the same.
You don't reduce exposure to consumer and mid-cap IT?
No, I think we continue to like the consumer and the IT space. I think post this correction, IT looks fantastic. And I think it doesn't mean that, of course, the correction phase is over. You could still see a correction till about mid-April when the earnings season and the guidance season kicks in. And I think that should be looked upon as an opportunity because clearly if you look at the large cap IT, it's a good thing tactically that the managements have actually come in and said that Q4 is weak, but nobody's really saying FY15 is going to be weak. So even if for FY15 you have these companies coming in and giving you 15 to 20% earnings growth, even in rupee terms, I think in the current context it's very good. At these valuations it's not bad. I think Infosys probably comes down to about 15p multiple FY15. I don't think that's a bad valuation parameter. That's at a discount to the market, which I still think is good. Mid-cap IT I think has corrected significantly. If you look at the recent highs which they had between January, February, March, most of the mid-cap IT companies have corrected by about 20%. But I think that presents an excellent entry opportunity.
Nilesh, talking about Infosys, you've always believed, or rather we've always seen this play out, that Infi has the habit of under-promising, over-delivering. Do you think it's a strategic move this time around as well? And is that how you would read it, that they would beat the guidance and, all the slowdown that they've already talked about?
Well, with Mr. Narayan Murthy out there, it's fair to assume this, because this is essentially a reasonably old strategy which they have practiced over the years and which has worked very well. I think it makes sense because they would want to basically lower the base for FY14 and say that we've done a fantastic job over FY15, FY16, the 2 years, because those are the final 2 years which he has as the executive chairman of the company. So I think it looks like at this stage that it seems to be a very conscious strategy, if not a deliberate strategy, to basically kind of calm down, tone down, say Q4 is weak, take away the froth from the market. It's helped in a close to 20% correction in the stock price. So I think it seems to be that it looks like it's working to a plan.
So Infi is still a buy on dips?
I think so.
At what levels do you think it would correct?
See, I think current levels itself is attractive, but let's assume because of the correction in the marketplace, it comes down to about 3,000, 3,100. I think that will be a brilliant buy. You're back to where it was 12 months back, with the company at least looking in a much better shape versus where it was 12 months back. It surely is still work in progress. It's quite possible that the first half of next financial year could still not be as great or may not be as good as what we would want it to be. But definitely the expectation levels have come down. And I think that's very, very important. This market is essentially a function of the delta in growth. And I think the moment you see that delta in growth, if sequentially numbers turn out to be good, Q1, Q2 of next financial year turn out to be much better than Q4, I think that would be very positive for the stock.
Let me pour cold water on your argument. Rupee, it's not at 68, it is not at 66, it is sub 61. 1% drop in rupee means a 1.5% dent in margins.
See, I think we'll have to look at the average rupee rates which were there for the entire FY14, rather than see where it was in, say, August or September, where it had gone to 69. That level of 68, 69 was very temporary. But I think if you look at the full year average, I don't know what that precise number would be, but it would not be definitely be north of 65.
Yeah, sure.
Number one. Number two, I think somewhere the government and the central bank clearly have taken a kind of a paradigm shift that we do not want a very strong currency. We do not want an appreciating currency. We've paid a price for having an appreciating currency in 2009, 2010, 2011. And I clearly believe that at still this stage, the bias of the government or even the next government would be to basically continue to push or boost exports. Even with this kind of a currency, exports actually last month had degrown by about 3%. So I'm not too sure whether the government or the central bank really wants a strong currency or not. I still think that the bias would be to kind of have a rupee which is more like this band of 60 to 65 rather than look at it at levels below 60. It could fall below 60, but it may not stay there.
But Nilesh, what about TCS? They are not in the habit of under-promising.
Yeah, but see, what have they said? They've just said is that Q4 is going to be weak. And they've said that it's because of the India business that they're going to see the weakness. But in aggregate terms, what have they said is that FY14 is better than FY13 and FY15 is going to be better than FY14. Okay, so if you really kind of are not too focused on how the March quarter is going to be, but really kind of look at how the next financial year is going to be, the management is still guiding that it's going to be even better than FY14, and FY14 on the whole has been a fantastic year for TCS. So if FY15 is even going to be better than FY14, then I actually think that that's a huge positive message that they are basically giving out to investors. So clearly
it's time to lap up both Infi and TCS.
I think so. Of course, the price shave off in Infosys is much higher. Valuations of Infosys are more attractive, and the room for positive surprises on Infosys is much more versus TCS post this price correction. So to that extent, I think from a pure price point of view, probably Infosys looks a little more attractive.
Persistent Systems coming up on your screen. 1031. Will Nilesh Shah buy Persistent System at 1031?
Yeah, I think it's still good. The only thing is that obviously it's run up quite a lot. I think it makes sense if you have a 2-year horizon. If you're having a 2-quarter horizon, then maybe it's still not a suitable entry point. Psychologically, the levels below 1,000 rupees, I think, provide a lot of comfort. That's typically way from a psychological perspective. If you look at from a valuation perspective, they'll probably, FY14, they'll probably do between 58, 60 rupees a share earnings. At about 15 times that price would be about 900. So my sense is between 900 and 1000, I think is a reasonably good entry point for somebody with a 2-year horizon.
Last time you told me you don't own banks. Any regrets? Because banks across the board have appreciated. Are you regretting that call?
Not really, because we still believe that that sector is still in a downtrend. Over the last 1 or 2 years, you've seen many trading rallies come in the banking space. We don't think the worst is over. We still think there's reasonably strong ownership in the banking system, and there are stocks and sectors which are even doing better than banking. So to that extent, I think probably if you really look at mid-cap IT or select mid-cap consumer names, they've done even better than banking versus their lows in sometime in August, September. So I think this is essentially a place where you look for bottom up and then try and pick your best story, your best stock within that.
Telecom as a space is holding on pretty okay today. Idea, Bharti, as well as Reliance Communication. This is not just the only day when you've seen a run up. In fact, it's been a vertical move up when it comes to Telecom, holding up by about 2.5%. But Nilesh, just coming back to the point that you were making, you don't like private banks. What about microfinance as well as NBFCs? Is the story going to play out there?
They look relatively better. I think versus the private sector banks, which are trading at several multiple times their book values. I think there is basically a turnaround situation in a lot of the microfinance and NBFCs. And I think that's clearly where you could see some upside from here. I think the managements out there have pulled up their socks, have basically come out with a turnaround strategy, implemented the turnaround strategy, and I think on a relative basis, they look a lot better versus, some of the frontline private sector banks.
So SKS Microfinance?
I think that's the only microfinance entity listed. So I think by default,
I just wanted you to say
that becomes a choice by default, So yeah, that's the only play you have.
Would you buy SKS Microfinance?
Well, we don't own it as yet, but I'm just saying is if somebody really wants exposure to the BFSI as a space, then I think there is potential for microfinance or housing finance companies or NBFCs to outperform the leading private sector banks.
Are you fully invested?
No, I don't think any fund manager at any point of time is fully invested, but we've significantly increased our allocations and we've significantly increased our
But the interesting bit here is that you're still buying into consumer names, IT. You're not really buying into cyclical PSU banks or industrials.
No, I think we have started buying into cyclicals, but I think these are companies which probably depend on cyclical businesses, but their business itself may not be significantly cyclical. So
Give me an example.
For example, the latest addition is Engineers India.
Okay. A PSU stock.
Yeah, but it does not have the characteristics of a PSU. Okay. If you really look at Engineers India, the stock is at a multi-year low. The 5-year high is some 500 plus. It's sub 200 right now. If you look at the last 5.5 years adjusted earnings, average earnings, they've had an average PAT of 500 crores. Virtually 90% of that has flown as free cash flows. On that, the net margin works out to 20%. It pays full taxes. It's got a good technical capabilities, kind of a quasi-monopoly. Order book is building up. No significant investments have happened in hydrocarbons and petrochemical space. I think that is going to change. They are beginning to get orders, and I think in the next 3 to 5 years, one does expect significant investments in the hydrocarbon and petrochemicals as a space. In addition to that, they have forayed and ventured into a lot of the non-hydrocarbon, non-petrochemical space, which is still insignificant today, but has the potential to deliver some kind of alpha in terms of their growth. In terms of valuations, it probably trades at about 12 times trailing earnings based on those cyclically adjusted earnings, 12p multiple, which I think for a company which is debt-free, which generates so much of cash flows, where you really which is an asset-light model or virtually no asset model, I would say, not even an asset-light, but virtually no asset model. I think it's a good kind of an investment.
What's the dividend yield for the stock?
I'm not too sure about the dividend yield because I think the dividends which they have declared are still very low, but I don't think Engineers India, you should really look at it as a dividend yield. It's not an ONGC or a Coal India that you say, fine, I'm not too worried about what subsidy hits which will happen and things of that kind. Here is a company which makes solid earnings even at the bottom of the cycle. This company makes 500 crores of PAT, 20% net margins and 20 ROE of more than 20%.
Okay, some data for you. 3.5% is a dividend.
Okay. Just want to see what Reliance Communications is up to, because that really is breaking out right now. 124.60, both in terms of volumes as well as price action. This one is turning out to be quite the stunner within minutes of opening bell. Nilesh, what about telecom? A lot of people are now turning towards telecom. Is the worst over for the sector, or because of the regulatory intervention you would still stay away?
I think it's a sector you should stay away. I don't think it really makes sense for somebody who's looking out for solid absolute returns. If you're really a very large institutional investor, you're running a portfolio which is driven by benchmarks and you need to make some allocation telecom, then you probably need to buy any of the telecom stocks. But otherwise, I think this is now a highly commoditized business. There could be vulnerability in terms of how technological changes happen. Valuations are no longer cheap. There are definitely regulatory interventions which act as speed breakers to the sector. So I don't think one should really own this. The only upside can be that if there is M&A activity, because now 100% FDI is allowed in telecom. So if over the next few months, few quarters, few years, you see some M&A activity, then that could create an upside for any stock which you own. But otherwise, I really don't see any merit in owning telecom stocks.
Tata Communications as well, by the way, is added to the list of the gainers. That's the one which, again, is holding out in trade. But what about metals, Nilesh? Because no one seems to be figuring out what's leading to the move. I mean, are these just trading moves, or are these investment bets that people are taking in metals?
Well, at this stage, it looks like that they are purely trading bets. Typically, these are beta sectors or rate sensitives, as they are called. And I think that's clearly the move which is happening. I don't think this is investment-led buying. Probably the only positive thing, the way you want to look at it, is that post 16th May, new government, new levels of economic activity, investment cycle kicking in, and therefore a lot of bans on mines could be lifted and mining activity could come back to normalcy, and therefore that could drive earnings. But I'm not too sure how valid a hypothesis is that, because metals are still a global play, and if you really look at world over, nobody's really talking about a hyper growth phase. China is basically cooling off significantly. Demand for metals looks pretty weak. Metal prices have been coming off. So to that extent, I'm not too sure whether there's a very strong fundamental investment-oriented buying which is happening. It seems to be more a beta play.
You know, someone has tweeted me, I'm not that active on Twitter, but maybe you're there, someone's watching the show, and the question for Nilesh is that, what is the next multi-bagger idea?
I'm not sure if that is anybody else's question. That is, no, I still think that at these kind of levels, you probably need to look for a multi-bagger in the tech space. I think that's clearly where the earnings momentum is going to be very, very strong. There is a potential for a positive surprise in terms of business model. Technology as a sector has the ability to create excitement value also. So multi-baggers don't just come from purely earnings growth. I mean, surely that's been the case for the last 2-3 years, but when you enter a bull market, that's really, it also comes in from a lot of the excitement value which a sector creates. Technology has the capabilities, so that's one. Two, I just alluded to Engineers India, which has been our latest position. I think the stock is at a multi-year low, but in the next 3 to 4 years, if the order book accretion materializes, if economic activity picks up, I think valuations are reasonably attractive. It has the potential to kind of at least be a multiple. I'm not too sure about it being a multi-bagger or not, but it surely has the potential to be a multiple from where it is now.
Right. What about auto components? Any names that you like there?
Auto components still looks good versus auto, because in auto, obviously, OEMs always have a risk that their particular product category does well or not. But I think the auto component space looks attractive. I think over a period of time, we've been more focused on companies which address multiple markets at the same time, which is a domestic OEM market, a domestic replacement market, and an exports market. So I think clearly companies which fit all the three kind of segments, I think would probably end up being outperformers.
We believe in names. We don't understand anything.
Right?
Yeah, I think of course that's done extremely well, but I think if you go down, and there are a few companies which basically make shock absorbers, there are companies which make air conditioning units for cars, there are companies which basically make upholstery for cars. I think these are some of the companies and some of the businesses which have been doing well and are expected to do well. Valuations are still reasonable.
Upholstery, which one's that?
I wouldn't want to get into specific names.
Okay, so if I have to, let's say, write 3 names, which are your top ideas for 2014, why don't you tell me and I'll write them here?
Well, I'm not too sure about the 2014 part of it, but I think companies which we like, I think in the consumer space, what we like is Zydus Wellness. I think valuation, stock has come off a lot. Valuations are reasonable, and it's quite possible that over the next 12 to 18 months, they could do a lot better versus what they've done in the last 1 or 2 years.
So Zydus is not growing, but I looked at the Q3 numbers.
Yes, so yeah, but that's why it's also available to us at say 15-16p multiple. It's not at 30-35p multiple. So that's really where the potential lies, that if growth comes back, over the next 12 to 18 months, then you could see the P multiple go from say 15 times to 25 times. So, and add to that a 15-20% growth for 2 years, and there is a potential upside over a 1 to 2 year time frame. So that's one. I think on the cyclical space, or as you would want to call it, I think Engineers India is something which we own. That's our latest addition. We like that. And I think on the technology space, companies which we own, I still think Persistent, NIT Technologies, these are names which we like, which we own. I think these are, three ideas which we think will do well for the next 1 to 2 years.
What are your price targets?
I don't know about the price targets, but I think each one of them are trading at a discount to their leaders in their respective space. So Zydus trades at 50% discount. Persistent doesn't trade anymore at a discount. NIT Technologies trades at a 50% discount. Engineers India on a standalone basis is good. So I think in each of these companies, I think also one thing is that when stocks are in uptrend, I think it might be a bit fatal to just have simple price targets, because these are growth-oriented companies where the ability of managements to come and surprise you on the upside, I think is huge. If there is relative under-ownership, then I think again that's the icing on the cake. So you could have a situation where there could be P/E rating which is even beyond your own expectations.
Nilesh, we could go on and on chatting with you. We're going to have to let you go on that note. Really appreciate you taking the time out and speaking with us.